Hello, I'm Matt Baer, president of the Baer Financial Group, and I'd like to take a few minutes to address two basic practices within the financial industry. It's often one of the first things I'm asked to discuss when I sit down with new clients. It's the difference between fee-based and commission-based financial advisors, and of course, the costs associated with each approach. Let's begin with fee-based advisors. In a fee-based relationship, you'll be first responsible for paying your advisor to manage your investment assets. And second, you'll be required to pay for the net operating expenses associated with that investment. Investment assets are financial products like stocks, bonds, mutual funds, ETFs, REITs, unit investment trusts, or even third-party money managers. There are several types of investments that can be used to help grow your portfolio. No matter what investment you choose, however, you'll be charged an advisory fee. That fee will automatically be paid from assets in your account. Also know that your advisor will charge an advisory fee regardless of what's going on with the actual investment. That means whether your account is performing at a high level or less moderately, the fee will remain the same. So how much is a typical advisory fee? Today, the industry standard is often 1% at $1 million. Lower asset amounts can see advisory fees over 2%, while higher account values will drop below 1%. Now remember, paying your financial advisor to manage your investment assets is just half of the fee-based equation. You must also pay the net operating expenses associated with those investments. Investment assets like individual issues of stocks and bonds do not have operating expenses because they are a thing with no employees or trading costs. However, mutual funds, ETFs, or basically any other kind of investment do have net operating expenses. Net operating expenses are charged on all investments that have employees, utility bills, trading expenses, and marketing costs, to name a few. These investment companies exist from money from within the investment. It is important to understand these additional costs because they do affect return. A net operating expense will commonly be between 0.5% and 1%, but can be much, much higher. As an educated consumer, you need to understand that many advisors will say they're only charging you 1% or whatever advisory fee you've agreed to, but as we've just seen, that's not the whole story. If the advisor is charging you 1% to manage your money and the net operating expenses of the investment they're choosing to use is also 1%, then your true cost to invest is really 2%. Now let's switch gears and take a look at commission-based relationships. Commission-based financial advisors are compensated primarily by the company and product they are recommending. Commission-based investments tend to be more time frame driven from a cost structure standpoint. Is your goal for the money more near term, like buying your first house or funding a college education, or longer term, like saving for retirement or buying a vacation home during retirement? If your goal is more near term, then your dollars will be reduced by some percentage coming off in the beginning. The advisor gets paid through that percentage. If the goal for the money is longer term, then the advisor will get paid directly by the company for which they are recommending. In this case, 100% of your assets are invested with no fee reducing capital. In all cases, the advisor can get a trail based on the performance of the account, so the better the account performs, the more the client and advisor make. The biggest distinction between fee-based and commission-based investing is that in a fee-based relationship, the client pays the advisor directly, and in a commission-based relationship, the investment company pays the advisor. The fact that many investments can be bought on either platform makes it most confusing. The challenge for the client is to understand all the combinations of choices and not get lost in the idea that cheaper is better. At the end of the day, because environmental changes in the industry have been accelerated by the Department of Labor's push to define fiduciary, many commission-based investments are being structured more and more like fee-based accounts. Finding an advisor who understands these differences and uses them to benefit their clients from a cost and risk mitigation standpoint is key in knowing you're in the right place. Knowing these terms will help you navigate the fee commission-based waters. Advisory fee, net operating expenses, front-end charge, breakpoints, contingent deferred sales charge, core charge, and asset fee. Investment costs are going to be charged one of three ways. 1, upfront, 2, along the way, or 3, on the back end. You are never going to see two of these methods used at the same time. For example, You will never be charged an upfront fee and also be paying along the way. You will never be paying along the way and have an on the back end charge. What you can have in all cases are net operating expenses and pay upfront or along the way or on the back end. This is a crude way to separate in your mind what you're paying the advisor, whether fee-based or commission, versus what the internal costs are for the investments you are using. At the Bayer Financial Group, we rely on a combination of fee-based and commission-based investing. If there are such great opportunities on both sides of the fee commission-based fence, then why would any advisor want to limit their clients' choices? Our focus at the Bayer Financial Group is putting purpose to money. We want to match dollars to the appropriate time frames and correlate risk based on the time in which the money may be needed by our clients. By using a combination of fee-based and commission-based accounts to accomplish this goal, we not only lower our clients' costs, but are also better able to manage risk. We begin by taking each of our clients through a 2 to 4 step process designed to evaluate their needs with precision, make recommendations that will help them, not hurt them, and lay the foundation for a long-term relationship. This process allows us to design a specific plan where we're putting purpose to our clients' investments as opposed to throwing everything in one big hopper, hoping for the best. Our clients pay between 1% and 1.3% of their total investments to partner with the Bayer Financial Group. That 1% to 1.3% is total costs. That includes all advisor fees, net operating expenses, anything you can think of. Understanding expenses is vitally important, and knowing if the results you have achieved are acceptable to the current environment. This knowledge will also help you judge the value your current advisor brings to the relationship. The Bayer Financial Group has a 30-year history of cost-effectively helping our clients exceed their financial goals. We would love for you to be our next success story. Thank you for watching this video. I hope you found it helpful, and please keep checking this website and our social media sites for additional information. Thank you.